Hello, everyone, and welcome. Thank you for joining today's webinar. This is on Seller Notes Uncovered. My name is Trevor Crow, and today we're going to demystify how seller financing works in the lower middle market, M&A deals, and try to provide a strategic breakdown of what you need to know when it comes to seller notes. This session, I would say, is designed for first-time buyers and sellers out there looking to buy or sell businesses in the lower middle market. And my goal is going to be to inform and empower you guys to, whether you're considering offering a seller note as a seller or requesting a seller note as a buyer, so you can approach your next deal with your eyes wide open and maybe with a bit of confidence in negotiating these terms. Mainly for this presentation, I'm talking in the context of what the kind of type of deals we work on in my experience. And so those are kind of seller notes and deals between $1 to $25 million purchase price. Before we dive in, a quick note on format. I'm going to be walking through these slides here that hopefully everybody can see. And we're going to, but to keep things engaging, if you have a question, please let me know, and just put it in the chat function is where it should be, and I should be able to see that as it comes up. Chat or the Q&A. Oh, it looks like chat. So put it in the chat, and we can go ahead and keep things moving. All right. Let's see here. So first, quickly about me, Doida Crow Legal is a firm. My name's Trevor Crow, as I mentioned. Our core focus is helping entrepreneurs solve complex business problems. And we work with entrepreneurs and buyers and sellers of businesses. We really focus on M&A deals, private securities offerings, and general corporate work. That's me on the in the gray suit in this picture. I'm happy to answer more questions on my background as those come up, but really we have a short presentation here today, so I want to keep things moving. All right, so here's our roadmap, and apologize, I keep looking over here. I got to pull up my thing from time to time, but our roadmap here, we'll start with the basics. So we're going to work through why both buyers and sellers use seller notes, dig into some of the key terms, some of the common questions that we get on these, look at pitfalls and things like that. So agenda, what are seller notes, why use seller notes in M&A deals, some of the key terms, common questions, and pitfalls. And then, we'll reserve some time, hopefully, for some Q&A at the end. But again, please feel free to ask questions along the way. All right, let's see here. So what is a seller note? Well, so at its core, a seller note is simply a loan from the seller that the seller extends to the buyer as part of the purchase price. So instead of receiving all of the purchase price funds at closing, the seller finances a portion and it gets paid over time. We have a deferred purchase price payment, and you may have heard it called seller financing, seller note, seller carry, a lot of different names out there, but essentially it's just documented as a promissory note to cover part of the purchase price so the buyer doesn't have to come to the table with all cash at closing. These are interest-bearing loans, so they are loans kind of like you would think of a bank loan. They have interest on them, excuse me, and usually there's some sort of schedule of payment, so monthly or quarterly installments, payments along the way. Sometimes it's on standby for a while and it's only interest only, but that's how it's kind of set up. It's going to be an interest-bearing loan, and these are very common in mid-sized deals. Seller notes are really prevalent in lower middle market acquisitions. Many first-time buyers either don't have enough cash or bank financing to cover the full price. So the seller financing bridges the gap there. And one industry statistics I pulled from Morgan & Westfield, which is a known M&A advisory firm, they said it said that less than 10% of small business transactions are all cash. So it's really the vast majority involves seller financing or some sort of contingent payment. And so if you're a seller, being open to a seller note is going to increase your pool of potential buyers and most likely the likelihood of closing as well. And if you're a buyer, just asking for a seller note is not an unusual term. So it's practically expected in most cases. So I wouldn't, if you're a buyer out there, I wouldn't feel, shouldn't feel strange to request a seller note. You know, I wrote down here, it's subordinated debt. Certainly, if the seller note is, if there's a bank loan or a senior lender, it's always going to be subordinated to the bank loan. And then, you know, secured or unsecured, that varies. That gets negotiated as part of the deal, whether it's going to be secured or not, and how that looks. And so we'll get into more of that later into the presentation. All right, so why do buyers use seller notes? Buyers love seller notes for a few reasons. One is they, as I mentioned before, they bridge the valuation gap. So these notes help reconcile valuation differences from time to time, and also financing ability. And so if the buyer can't reach the asking price up front, a seller note may cover that difference, and in what they can pay for right now. And it reduces, as I said, the amount of cash that the buyer needs on day one to close the deal. Two, it increases deal success. Often offering a seller note can make deals possible that would otherwise fail due to the lack of financing. So again, this is one that is helpful for the buyer and the seller, and that if the bank won't finance the full amount, then you have the ability to bridge this gap here with the seller financing. And that just makes life easier on the buyer, honestly, one, they're not stretched for cash or raising more equity, and it's easier for them to get that bank loan. So that increases the success rate. Another big reason buyers use seller notes is it aligns incentives and shows kind of seller confidence in the deal. So accepting a note signals that the seller believes in the future of the business, and that the seller is willing to kind of bet on the business moving forward, and is leaving some money on the table to be paid later, kind of reassuring the buyer that the business is solid, and that and that they believe they're going to be able to get paid. So, I think this alignment can foster trust during the transition, and can help, again, give the buyer some confidence that the seller has confidence in the way the business is structured, and the fact that it can meet these debt payments on the seller note. And then the other couple reasons here. One, I put smoother transition. Oftentimes with the seller, it still has a financial stake until the note is paid. They're often more willing to support the buyer post-sale with training and advice, because they want to ensure success of the business. That's important to them to keep it going and to make sure they get paid. And so that aligned incentives is helpful for a smoother transition. And that's helpful for, especially if the business needs a lot of transition services post-closing. The buyer is going to be less concerned that the seller is going to just ride off into the sunset and not be available for calls or emails or to help even with day-to-day or transition of the major relationships in the deal over to the buyer. So that's always helpful. And then lastly, there's a pot of money there for indemnification claims with a seller note, especially if it's negotiated that it can be offset for indemnification claims. That's important, and it can be helpful to for a buyer to know that if there are indemnification claims, so there's a breach of representations or warranties or breach of covenant in the agreement, that they don't have to sue the buyer to try to get payment. They can either offset the note, or there could be an escrow, I guess, as well. But assuming there's no escrow, then this is the kind of way that a buyer can get access to that money. Now, it's not cash right away. It's really just offsetting money that they would otherwise be paying to the seller. But it's still it still avoids the necessity to sue the seller in many cases, because you have this money that you can offset. Okay, cool. So great, all good for the buyer, but what about the seller? Why would the seller agree to this? And some of these we've already touched on, but sellers often agree to a seller note because it helps close the deal. It can, as I mentioned, it can get more people in, potential buyers in that can make an offer. It allows them to get bank financing easier, and so they just have a larger pool of people looking to buy. which in turn, can increase price and also help get the deal done, actually closed, and so that they can sell it. The second is that there's a tax deferral piece here and tax benefits. So, if a purchase price is being paid over multiple tax years, that qualifies as an installment sale for tax purposes. And so deferring that, they can defer some of the capital gains or other gains that they have on the sale of the company from the seller side. And so, you get a lesser cash chunk that you have to pay tax on in each individual year. And so spreading that out over time means that you're paying less tax right now. And so that is a benefit a tax benefit for the seller, in that they can, sometimes it even allows them to be in lower tax brackets over each year. And so that's a definite benefit for them. So instead of paying tax on that full note at closing, the amount of that they can treat it as being taxed when they actually receive the money from payment under the note. So that's good. And then lastly, there's interest. Sellers also earn interest, which is on the unpaid balance, which is kind of boosts their total take in the long run. Usually these notes, and we'll talk about the interest rates later, but that can offer some additional money to them over time that they wouldn't otherwise receive if they got all cash over at closing. Well, that assumes that they couldn't get that same rate somewhere else, right? By getting the cash right up front. So the interest is definitely something that sellers look at and sometimes like. But there's risks to the seller, and so even though there are some benefits to the seller, which we just kind of went through, but there's risks because the seller is going to be very cautious about these arrangements. They're worried about they're worried about offsets, and how is that determined? And that's a highly negotiated provision in the agreements. How are these? How can the buyer offset for indemnification claims? Do they have to get a court order? Do they have to get a judgment? Do they have to go to the mediation before they offset it? Or can they just claim that there's a default and start offsetting the note? That's definitely a highly negotiated term. And then, sellers are taking on credit risk. They may not get fully paid. They're delaying their full payment of the purchase price, and they're taking on the buyers are taking on debt and this ongoing obligation to the seller. And so this definitely creates some risk. But I would say, net, these reasons we just discussed of why seller notes are so prevalent in this market, especially the lower middle market, I think outweigh the credit risk that they're taking on oftentimes, and that's why sellers go for it. And they just having a seller note solves a lot of practical problems that buyers have in buying businesses, and so that creates value really for both parties, and that's why we often see these seller notes used. All right, so key terms. What are the key terms of a seller note? One, we have a principal amount that's negotiated as part of the deal. We have a total purchase price, and then we have a portion of it paid through a note. And so what is that portion that gets negotiated as part of the, economics of the deal? And so principal amount is a key term in the seller note. And so that's something that will change it on deal by deal. Interest rate, that also gets negotiated. I would say that the typical rates that I see are 6 to 8%. In many of these, mid-market deals, but they can be higher if the deal is risky or if the market rates are up. Typically, the arguments go a couple different ways. The rate is typically higher than the bank loan rates because the seller's taking on more risk. They have limited collateral and they're subordinated to the senior lender, so to the bank loan. And from the sell side, the seller, they're saying, this is a more risky than that bank debt because it's subordinated, and the banks are in the business of doing loans, and they have security interest, and they have personal guarantees, and they have a diversified portfolio of loans that can make it so that one loan isn't as risky as their combined total set of loans, whereas we don't have that on the sell side, and so they're negotiating for a higher rate. On the buy side, you're saying this isn't really a typical bank loan that you're giving. You're showing that you have some skin in the game. You're showing that you have confidence in the business that you're selling, and it's really just a deferred purchase price payment, and it's not to be treated as typical debt. So that's kind of the argument on the buyer side, and so that gets negotiated, and usually, like I said, we end up in this 6 to 8% range typically. But I've seen notes as low as even 3 to 5%, and as high as 10 to 12%. And so it's often, does come down to the perceived risk and prevailing rates. But in the last decade, we've had lower interest rates, and so it's really, but that affects it a little bit. But I would say that people don't really look at this as, hey, what is this based on prime or LIBOR or anything like that. It's really just negotiated kind of separately and seen a little differently than a normal bank loan. So anyway, that's what I've seen as far as interest rates. Term and payment schedule, that's obviously a big piece of a note and how it would be structured. And so common terms, seller notes I've seen 3 to 10 years for repayment. Some notes, typically don't extend either shorter or higher than that I've seen. Shorter terms mean obviously quicker payouts, but higher payments. So you got to make sure on both sides, the seller doesn't want to create a note with a term so short that the buyer can't make payments. That's not typically what they want. They don't want to have to come in and have a default. They just want to get paid. So, you've got to figure out what payments can the business support moving forward, giving, conservative estimates. Longer term notes obviously means smaller payments along the way, but the seller remains tied to the business longer, takes on more long-term risk, and it also means that there's more interest over time that's paid by the buyer. So anyway, that's what I've seen, and sometimes that's dictated by the bank loan. The bank loan that the buyer's getting may dictate how long that term needs to be. Oftentimes it is, and they, particularly either on the way the payments are structured, they have to be low enough that the bank is comfortable with the payments, and then also, the bank may require that it stay outstanding for the term of their loan, and that's where sometimes you get those longer 10-year loans. Repayment schedule. So we kind of talked about that, but usually monthly installments, sometimes interest only for a short period of time. Sometimes no payments. It's on full standby for 2 years, for example, and there's no payments for those 2 years, and interest continues to accrue during those years, but then they're just paying either interest only during those times or nothing, and then they start to pay after that. So you can see a variety of different structures here on how a note can be set up. You can, there's a lot of levers to pull, whether it's principal amount, the interest rate, repayment terms, amortization, balloon payments, things like that. So there's a lot of different ways to set it up. I would say most of these notes don't have any prepayment penalties, so you can prepay anytime from a buyer, which is nice. But sometimes that gets negotiated different. And then, security and subordination, it'll always be, as I mentioned, it'll always be subordinated to a senior lender, like a bank, but security is negotiated. Sometimes it's, there is a second lien on the assets, or sometimes there's a pledge of the equity in the buyer entity. Sometimes they ask for a personal guarantee, and I would say that, that's a very, it depends on the situation of the buyer in that case, of whether that's important or not. If they're already personally guaranteeing a SBA loan that is well over their net worth, then what real benefit does that personal guarantee give to a seller who's going to have a second position in that? So I think oftentimes I've been successful in negotiating away that personal guarantee from the buy side. Although I've also, advised clients on the buy side that maybe it's not a big give. If we can get the seller to come our way on another point that we're negotiating, we can give up that personal guarantee and say, all right, well, we'll agree to this personal guarantee if you give us this. And really that might not be a big issue again, because if there's a default under the senior lender note, that personal guarantee may not be worth much anyway. So it's not really a big give from time to time by the buyer. And then the default terms, those are really going to be spelled out in the agreement and negotiated. Is it missing payments? Is there time to cure? Let me see here. Oh, got a question. Sorry, I got to look to my other screen to pull this over. Let's see. I know this is a fluid topic, but the recent proposed DOGE changes to the SBA, how do you foresee the attractiveness of seller notes? Proposed changes are that seller notes must now be full standby for the life of the SBA loan, no interest only period, and the 50% equity injection limitation. Yeah, this is definitely a fluid topic. I know the SBA came out with a new SOP recently that goes into effect on June 1st. So this topic has just got more interesting, and I honestly haven't had a chance to dig into it too much on those changes. That's something I need to do still. But yeah, I think that's going to certainly affect how this works. Seller note. I mean, my thought is that deals will still get done, and sellers will have to agree to it to get deals done, especially in the lower middle market, just because seller notes are so prevalent and often needed to finance the deal, that I think that this is just how it's gonna be. And so I'm interested to see how things flush out with negotiations, and how that changes interest rates that people are asking for, how it changes how much principal they're willing to go for. I think one of the things I could see this leading to is that buyers are going to have to raise more equity from outside investors, potentially to bring more cash to closing to really make this work. And so that's kind of one thing that I would anticipate, but it's a fluid topic, and it's yet to be seen on how exactly this is going to affect seller notes moving forward. Thanks for the question. That's a good one. All right, so let's keep going. I know we're set 7 minutes left, and we'll try to keep everything moving here so we can get through. But keep asking questions if you have them. All right, so documents involved. At a minimum, you're going to have a promissory note, right? So that's what documents and memorializes that there's a loan. So it'll be discussed in the purchase agreement, and it'll be a closing deliverable as discussed in the purchase agreement. So at closing, the buyer is going to sign a promissory note and deliver that to seller for whatever the amount is. And whether there's other agreements going, certainly there'll be a subordination agreement if there's a senior loan. So if there's a senior loan, then, whether it's the SBA subordination agreement or other intercreditor agreement, sometimes it's called, that basically says that's between the bank and the seller, that says, hey, we know you have this loan, but we also have a loan, and your loan is subordinated to ours. So you can't go collect under your note or foreclose on any assets or do anything unless we get paid first. And so that's really what the subordination agreement does. Sometimes it says that even the lender can force the buyer to stop making payments under the seller note. And so those get negotiated, and with the SBA, usually there's just a form subordination agreement with some check boxes on how it works. And I'm not sure if that changes, honestly, with the new SOP, but we'll have to see how that plays out. And then security agreements, pledge agreements, as I mentioned, personal guarantees, those are negotiated and sometimes part of the deal and sometimes not. If they are, then those will be, again, closing deliverables mentioned in the purchase agreement and delivered at closing. The security agreement is used when you're securing the assets of the business. And so it says if you default under the seller note, they have a right to go after the assets of the company and to foreclose on those and sell them off for payment of their note. Now, again, that's going to be subordinated, and it's going to be a second lien. And so they would have to sell those and pay off the first lien first, and then come in and take the remaining to pay off their debt. So again, security agreements, may or may not be worth much depending on what the assets are of the company. A pledge agreement is similar to a security agreement, but instead of securing the assets of the business, the pledge agreement is a pledge of the equity in the buyer entity. And so, buyer buys the assets of a seller business with a LLC that they form to be the buyer in that entity or buyer in that transaction. The pledge agreement would say buyer is pledging their membership interest in that LLC to seller as security for payment of the note. And if the note isn't paid, then they can come in and take over those membership interests, and then now they own the company. The seller would own the company and be able to, use that to pay off the note that they have. And so, both can be used and both can be negotiated. Guarantees, we've kind of already talked about that, but that's, gets negotiated on each deal, whether there's going to be a personal guarantee from one of the principals of the buyer that says, if I default, then you can come after my personal assets. That's how that would work. All right, so common questions that we receive from sellers. So, how do I make sure I get paid? Well, you make sure you get paid by keeping close contact with the buyer post-closing, making sure that their operations are successful and that the business continues to operate in the normal course and can pay off your note. So that's one tip that I give. Also, they make sure they get paid. You can have, negotiate some of these security agreements, pledge agreements, things like that. Those are also ways that they can try to ensure that they get some sort of payment or even personal guarantees. Question, can I ask for interest or security? And so yes, certainly interest is always part of any seller note deal. Security, we kind of talked about that. Yes, you can ask for security. You just have to determine whether you think that security is actually worthwhile. Is it going to be something that you can use? If there's no hard assets and it's all goodwill, then really what do you have to sell? Even if you were able to come in and take the assets of the company without having to come in and actually run the company again yourself. But, I've seen that before too. Where I've had seller clients that have had security agreements, have taken over the business and then sold it again later, after they've come back in to buy back the business after there's been a default of the seller note. So what if the business tanks? Well, if the business tanks, then you have your rights under the promissory note. You can either, if you have security, you can go after that. If you don't, then you're getting a default judgment against the buyer entity and trying to get paid from whatever assets that they have. And then lastly, can I accelerate payment on the note on default? And yes, usually all promissory notes have some sort of acceleration. So if they miss payments, the buyer misses payments, then you can accelerate it and make it all become due and payable and kind of force the issue, force them to either pay it all off or right now, or that you get a judgment and start taking over assets. And so that's oftentimes included in these seller promissory notes. All right, buyer questions. What if I can't make payments? Good question. In those situations, we try to build in protections for the buyer, right? So we have provisions in there that say, you have a notice, an opportunity to cure, or maybe you even have some sort of built-in, if revenue is down by a certain period, then we can pay a lesser amount, or we can stop making payments for a period of time until revenue gets up without a default, things like that. So those things can be built in. Sometimes there's forgivable seller notes, which are allowed under the SBA rules, where you can forgive some of the note if something happens. So for example, they lose a big customer. Maybe the seller note is reduced and forgiven for a portion of it. So that's something to think about as well. The SBA loan piece of it, that's important to think about, if how that's going to affect it. Usually it's helpful for the loan, but there are some tweaks, like the standby period and potentially no ability to prepay it can also come up. And sometimes there's issues with offsetting it for indemnification claims, especially if that note has been used towards as a portion of the injection of equity. So there are some issues that come up with SBA loans. Can I prepay or refinance it? Usually that's permitted, not an issue. And do I get flexibility during tough times? Again, that's all negotiated, and whether you can put that in the note or not. All right, just a couple more. We're going to go a little bit over. Sorry, I know we're at time, but I just want to get through these last couple. So, common pitfalls that I see and how to avoid them. One is that there's no security or subordination clarity in the documents or in the early negotiations. And so, if you don't talk about that early, whether there's going to be a personal guarantee, I've seen a lot of LOIs where there's no talk about security or subordination or personal guarantees, but when we get to documenting the agreement, the seller is asking for all these things, and we're saying, well, why didn't you negotiate that in the LOI? That's a major term that should be in there if you wanted it, and so it's a major change, and so negotiating that early is important. I would say vague default definitions or sometimes covenants in ZOTE, and I'm talking more from the buy side here. If you're a buyer, you really want the defaults to be limited to payment defaults, not that you've breached some covenant, like you've sold an asset out of the ordinary course of business, or you failed to provide financial statements to them on a monthly basis, something like that. As long as you're making payments, you really kind of want to limit those default provisions to just payment defaults. No enforcement path. I see that from time to time, that there's vague language in the agreement, and there's no real way on how the seller was, and this is more talking from the seller side, way to enforce it. And then lack of communication or expectations. That really goes from the first one about early negotiations. You really want to communicate and talk about expectations, talk about the standby that the bank's going to require, talk about subordination, all that early on, because I've seen many sellers get upset by finding that out later because it wasn't discussed with them early or included in the LOI. All right, so conclusion, what do you do? Really, seller notes equal strategic leverage. They're often used in important parts of these deals, and so I think it's getting comfortable with them is important. And you want to protect interest through strong documentation. The documents need to be clear and negotiated to really fit the deal that's at hand. And then you want to make sure that you negotiate early in the process. So at the LOI stage, you're getting a lot of the terms of this note put in there, so there's no issues later. And then ask questions, plan proactively. Those are always important things to do with seller notes. So that's going to wrap us up. If anybody has any additional questions, I know, just send me an email. All my contact information's here. It's just trevor@doidacrow.com. Please feel free to send me an email. Happy to answer any questions that come up, and appreciate everybody attending today. Thanks.